We'll be diving into the latest developments in the world of stocks and finance, bringing you updates, analysis, and insights to help you navigate the complex landscape. We start with a significant story making waves in the financial markets. The U.S. stock market is experiencing a rebound, particularly in software stocks, after a recent sell-off. Datadog is leading the charge, up more than 6%, followed closely by Microsoft, which has gained over 3%. Other notable gainers include ServiceNow, Atlassian, and Oracle, all of which are up by more than 4%. Cybersecurity stocks are also on the rise, with Cloudflare seeing a significant boost of over 5% after being upgraded by Piper Sandler. Okta and Zscaler are also performing well, with gains of over 4% and 3% respectively. However, not all sectors are faring as well. Chipmakers and AI infrastructure stocks are under pressure, with SanDisk down more than 5% and ASML Holding NV losing over 4%. Other companies in this sector, such as Seagate Technology Holdings plc, KLA Corp., and Lam Research, are also experiencing losses. In other news, Robinhood Markets is up over 7% after the SEC approved changes to restrictions on day trading activity by small investors. Snap Inc. has also seen a significant gain of over 7% following its decision to lay off 16% of its global workforce in an effort to reduce costs and achieve profitability. Morgan Stanley reported a strong Q1 equities trading revenue, beating consensus estimates, which has led to a gain of over 5% for the company. GitLab is also up after announcing a collaboration with Google Cloud, and Broadcom has expanded its partnership with Meta Platforms to deploy AI infrastructure. On the earnings front, several major companies have reported their Q1 results, including Bank of America Corp., First Horizon Corp., J.B. Hunt Transport Services Inc., M&T Bank Corp., Morgan Stanley, PNC Financial Services Group Inc., and Progressive Corp. Eth. As we continue to monitor these developments and their potential impact on the market, it's essential to maintain a balanced perspective, considering both the gains and the losses. The financial landscape is constantly evolving, and staying informed is key to making wise investment decisions. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into a fascinating topic that affects many of us, the world of car financing. As we explore the pros and cons of longer loan terms, it's essential to consider the potential risks and benefits. Recently, there's been a trend towards extending car loan terms, with some buyers opting for loans that can last up to 7 years or more. On the surface, this might seem like a convenient option, as it can lower monthly payments and make it easier to afford a new vehicle. However, it's crucial to examine the potential drawbacks. One of the primary concerns is that longer loan terms can lead to paying more in interest over the life of the loan. This means that buyers could end up paying thousands of dollars more than the initial purchase price of the car. Additionally, vehicles depreciate rapidly, so there's a risk of owing more on the loan than the car is worth at some point. Another factor to consider is the impact on future financial decisions. With a longer loan term, a significant portion of your monthly income will be allocated towards car payments for an extended period. This could limit your ability to achieve other financial goals or respond to unexpected expenses. To mitigate these risks, it's essential to carefully evaluate your financial situation and consider alternatives. Saving up for a larger down payment, strengthening your credit score, and exploring options like used cars or leasing can help you make more informed decisions. Ultimately, the key is to find a balance between affordability and long-term financial sustainability. By weighing the pros and cons and considering multiple perspectives, you can make an informed decision that works best for your unique circumstances. Welcome back to the Riskwiser Zone. As we wrap up today's show, let's take a look at some developing news that could have significant implications for the global economy. We've got two related stories that caught our attention. one from the world of geopolitics and another from the realm of international finance. It appears that tensions in the Middle East are having far-reaching effects, with the war causing disruptions to global energy supplies and sparking concerns about inflation and economic stability. In response, the Group of Seven Nations has issued a statement reaffirming their commitment to moving towards a lasting peace in the region. French Finance Minister Roland Lescure emphasized the need for G7 countries to be ready to act to mitigate the economic and inflation risks caused by the war's energy and supply shocks. Meanwhile, in a related development, finance chiefs from the G7 nations met on the sidelines of the International Monetary Fund and World Bank spring meetings in Washington. They discussed the urgent need to limit the cost to the global economy of the ongoing conflict and agreed to continue supporting Ukraine, including helping it prepare for next winter after a difficult year marked by constant Russian attacks on Ukrainian energy infrastructure. In another significant move, French President Macron is reportedly seeking to draw international cooperation to address the crisis, with European leaders also meeting to discuss ways to stabilize the global energy market. The situation remains fluid, and investors should be prepared for potential volatility in the markets. It's essential to stay informed about these developments, as they can have a direct impact on your investment portfolio. As always, we recommend taking a cautious approach and diversifying your assets to minimize risk. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.